Hi everybody, my name is Shobit and today we're going to talk about a very famous book called Unusual Billionaire, which was written by Saurabh Mukherjee sir. In his book, he has mentioned seven unusual companies, and these companies are not just random. It has passed Saurabh sir's five major criteria, that is their market cap must be greater than 100 crore and their ROC must grow by 15%. Their revenue growth must grow by 10% every year. And for banking industry, their loan book must grow by 15% and their ROE must grow by 15%. Let's look at the strategies what this companies has incorporated to pass this criteria. Let's see the Asian Paints. Asian Paints started its operations in tier 1 cities but got rejected. So it approached a bottom to up and it went to village and started its selling. It was aware that what they are selling and what market actually wants. So they filled this gap and increased their PBT margin by 2%, which is as of 20% in FY25. And when Marico started his business from B2B to B2C, their 15-liter cans was not sold. Hence, they launched 100 ml consumer pack so that they can gain trust of the consumers. And their main thing was that they used to pour 10% of profit into innovation. Astral Pipe did a very major thing that they shifted the whole pipe industry from GI pipes to CPVC pipes by catering real customers, that is plumbers. Axis Bank was a customer focused model and they didn't just open branches but they busted with the branches and they have 4.5 ATMs as of FY25 per branches. This increased their easy cash money and this also increased their cash ratio to 46%, which is as of 40% in FY25. And if you look at all these companies, these all companies are trying to do three major things. That is number one, they wanted to be first in the market, they wanted to innovate, they wanted to grow. Number two is they wanted to cater their real customer. Number three, they wanted to have an upper hand on the distribution so that they can cater their customers very properly. Now let's look at the architecture, how this companies is hiring their employees and what is their culture. Asian Paints is very much focused that they wanted to hire only from IM grads. Berger Paint did the same. They skipped the trial and error phase and hired only people, those who are best with their work. Page Industries have the highest retention because they hire people who are purpose driven, not salary driven. In Axis Bank, when Nayak sir joined, he introduced two major things. That is 10% ESOP plan and a hike in the salaries as compared to their competitors. And in HDFC Bank, people join on the basis of Puri sir's reputation, and he allow only employees who can build a bank from scratch if the bank become bankrupt. We saw that these companies have the good strategies and have a good architecture, and they both are very hunger to be number one. So their innovation becomes the heart and soul. Now let's see what these companies has innovated. For that, I would like to call Pal.
Hi, I am Pul Thakkar and let's go through the innovation part of these companies. When we heard the word innovation, we often think of new products and flashy technologies. But in the unusual book, Saurav Mukherjee sir shows that India's most successful companies innovated mainly in processes, executions, and systems. This slide captures how seven companies and used innovation to build long-term competitive advantage. Starting with Asian Paints, it did not win by inventing paint but by re engineering the entire supply chain. It adopted mainframe computer not for payrolls but for demand forecasting. Later, it used ERP systems, advanced analytics, and GPS enabled logistics to track delivery trucks in real time. This result was lower inventory, faster delivery, and better dealer service. This supply chain innovation helped them reduce their working capital and stay ahead of competitors for decades. Same with the Berger Paints, it did not win by inventing paint but by innovating its execution. It adopted an asset light strategy, outsourced manufacturing model which improved their ROCE. Tinting machines enabled mass customization. Later, express painting and integrated IT systems improved speed, efficiency, and customer experience, creating a durable competitive advantage. Marico transferred commodity products into premium consumer brands through innovation. It was one of the first FMCG companies to invest in enterprise wide IT systems. Marico also focused on designed packaging innovation, making products visually distinctive and difficult to imitate. Additionally, it builds structural barriers against counterfeiting, protecting their brand equity and consumer trust. Moving on to the banking sectors, Axis Bank focused on becoming a technological driven bank. It built an IT anchored transformation using data led credit decisioning to access borrower risk. Axis was an early stage digital first mover adopting Aadhaar based eKYC and scalable analytics. HDFC Bank shows how innovation can be boring but powerful. They introduced unique check settlement liberalization, centralized salary payments, and automated market settlements. They connected the entire financial ecosystems, investors, brokers, exchanges, etc. Astral Poly is an example of market creation innovation. Instead of competing in crowded PVC pipes, Astral innovated lead-free CPVC pipes in India when the market barely existed. They invented heavily in educating plumbers and builders, creating demand rather than chasing it. Operationally, Astral developed robotics-enabled manufacturing for consistency and scale. Page industry, the last one. The license of jockey in India innovated inside its operation. One key innovation is quarterly product renewal. Slow moving designs are dropped gradually and replaced with the new ones, keeping the product portfolio fresh. More importantly, Page built automated performance tracking systems that monitor operating efficiency of the customers. So these companies proves that lasting success comes from quiet innovation in processes and execution and not from flashy products and technologies. For next topic, I'd like to call Nikunj. Thank you.
Hello everyone, my name is Nikun Singhania and today we will examine a critical component of business strategy, branding. To begin with, it is first important to clarify what branding actually is. A common misconception is that branding is just simply a logo, a slogan, or a color scheme. While these are just visual elements, branding itself is far more profound. At its core, a brand is the identity of a company. It is the promise you make to your customers and the consistent experience you deliver. Today, we will examine four main areas of strategic branding. First, brand evolution and emotional connect. Successful business shifts purely from functional relationship with customers to an emotional one. So, like Asian Paint launched mascot Gattu and campaign saying "Har Ghar Kuch Kehta Hai" to emotionally connect with regular people in small towns. Axis Bank launched campaign saying "Badhti ka naam Zindagi" to transition its bank identity from a transactional service provider to an emotional partner in customers' life. Second, pricing power and premiumization. It is the ability to charge more without reducing demand by positioning your brand as high quality. For example, Berger Paint shifted from budget-friendly paints to aspirational luxury brand, which allowed them to charge more and gain pricing power. Third, dominance via visibility and tactical media. Dominance is achieved when your brand is the top of mind choice of your customers. Like Page Industries dominated innerwear segment by heavily positioning in MBOs, and Astral Poly advertised their products in news channels during elections to capture greater market share. Finally, digital leadership and efficient positioning. In today's marketplace, it is basically leveraging data for strategic advantage. Like HDFC launched campaign saying "Bank apni mutti mein" to promote their digital banking platform where they provided every banking solutions under one roof. And Axis Bank printed QR code behind their visiting cards for customers to open new accounts with Axis Bank easily and quickly. Thank you. Now I will like to call upon Vedanshu to present strategic assets.
Hello everyone, myself Vidanshu Patel and today I will examine the key topic of Unusual Billionaire book, that is strategic assets. When we study the strategic assets, we always one pattern appear again and again. That is, true wealth is not built by bold glamour or the dramatic risk. It is built by discipline and the patience. The strategic assets are the strengths that are hard to replicate and take years of time to build it. Let's understand this through some iconic Indian companies that feature in the Unusual Billionaire book, which was written by the Saurav Mukherjee sir. Let's start with Asian Paint. Its biggest strength is not paint, it's distribution. A deep dealer relationship with nationwide distributor network that's supported by the fast and the reliable supply chain that allow the Asian Paint to reach its product and the services to the retailer as much as faster and efficiency as compared to other competitors. Its distributor and its logistic reinforce each other that create an ecosystem which is extremely difficult for others to copy. This strategic asset has protected its leadership for the years of decades. Now let's consider the Astral Pipe. Estelpi creates its strength by manufacturing scale with its powerful distribution network, and most important that its plumber loyalty, trust, product quality, and on-ground relationships that create a strong entry barriers. For new players or say for the new competitors, replicating this same ecosystem is not just expensive, it is extremely difficult. Now let's move towards the Marico. Earlier, Marico heavily depended on its few products, but over the time, through the process of discipline and the patience and the portfolio diversification, it transformed into the balanced and resilient businesses. This focused on the system and the risk management that enable steadily sustainable growth rather than the violent expansion. And in the banking sector, HDFC created strategic assets by including a strong current account and saving account base that produce lower cost of fund, less risk awareness, and heavy investment in the field of technology. Most important that it execute consistently at a scale that other bank cannot manage it over the long period of time. And the last one is page industry that represent another kind of strategic assets that is asset-led business with a minimal capital that lead into the business that high return on capital employed and strong lead brand demand. It demonstrates that how efficiency it can self be more. Great companies do not chase in the short term gain. They patiently build their strategic assets in that way that others can copy it. In the end, strategy is not about speed, it is about durability. Now I would like to call Vanshika to present the competitive advantages. Thank you.
Thank you. I'm Vanshika. Now, building on to what we've just discussed, I'll now walk you through the key financial learnings that what drove their market leadership. First up, Asian Paints. The promoters kept reinvesting into systems and IT even though the returns were not immediate. Over time, this became impossible for the competitors to copy. Second, Berger Paints. The second learning here is brand demand is more important than discounts. Berger Paints stopped providing dealer discounts and start investing that money in innovation and advertising. As explained in the book, once a customer walks in asking for a particular brand, the dealer loses its bargaining power, and that's how Berger Paints gained its pricing power. Third, Marico. Make your partners rich and they will stick with you forever. Marico rewarded distributors with stretch targets and even foreign trips. Distributors trusted Marico, and this is why the company was able to deliver 55 consecutive quarters of profit growth from the financial year 2000 to 2014. Fourth page, industries, jockey. Control quality and delivery. Page Industries owns its manufacturing, avoids giving trade discount, and delivers the inventory within 2 days. The employee iteration rate of Page Industries is approximately 12 to 13%. That means fewer mistakes and consistent quality. Lastly, we have HDFC Bank. HDFC Bank adopted the centralized banking system way too early. By the financial year 2000, its CASA ratio, that is current account deposit plus savings account deposit divided by total deposit, was approximately 46% as compared to 17 to 20% for its peers, uh, giving it cheaper funds and unmatched stability. These are the advantages what we can see on the outside. Next slide. Let's dive into the secret sauce, unique strategies that converted these ordinary businesses into extraordinary long term winners. The first learning is that focus beats diversification. Asian Paints stayed in paint segment for decades, and this allowed Asian Paints to build a powerful supply chain network, and it served approximately 70,000 dealers efficiently. The dealers made faster money, so loyalty followed. The second learning is winning through speed and agility. Berger Paints always wins because it's faster and flexible than the market leader, that's Asian Paints. The management gives sales team complete authority to make instant decisions with the shopkeepers to win the target on spot. Third learning is low risk, high disciplined execution. HDFC Bank succeeded because of high disciplined execution rather than taking big risks. Building a network that cleared checks and moved money across different cities instantly, they attracted cheap deposits, and avoided risky loans. Their bad loans, which are the non performing assets, were below 2% of their entire loan book. Lastly, we have Astel Poly. Astel Poly didn't just sell pipes, they created a brand. They pioneered CPVC pipes in India through Lubrizol joint venture. This backward integration helped Astel Poly to increase its margin from 12 to 18%. Now, and by building deep loyalty with people who actually install the products, who are the plumbers, they turned a commodity into a brand that people ask for by name. These companies prove that secret sauce isn't just luck, it's about focus, discipline, and trust. To explain the power of inorganic expansion, I'll now call Devraj.
I'm Devraj Ravi. In this section, how explore how inorganic growth helps to scale the business, while capital discipline creates long-term value for the business. In simple terms, inorganic growth means expanding business by acquiring or merging with another business. So instead of building business from scratch, organic growth generally takes time, but inorganic growth comprises time. Why companies use inorganic growth? It uh, if business wants to diversify their portfolio, so inorganic growth helps them a lot. It allows business to enter into the new segment of the business. It also helps business to expand presence in the another geographical area. It also helped business to gain maximum market share in the industry, which ultimately decrease their competition. Let's see a couple of examples that author mentioned in the book. The Asian Paint acquired paint company in Sri Lanka, greenfield operations in Oman, SCIB Chemicals in Egypt, and controlling stake in Berger International Singapore to expanding their international presence. Asian Paint acquired Slick Kitchen and Ashes Bathroom Solution to protect their mom and pop store, while Berger acquired ICI Motor Paint business and their Nepal unit to to ac- uh, to gain maximum market share. Marico acquired oil of Malabar and relaunched it at a lower price to compete with HUL. Marico also acquired Nihar and hold 80% market share in the coconut oil segment. But currently it holds 62% market share because of their competition is growing day by day. HDFC acquired Times Bank and added 35 branch and bought Uma Krishnan into retail banking. Astral Poly also diversified its portfolio by acquiring adhesives business, two key firms, which is Resinova and Silt. How does ROC of the business impacted? Acquisition may impact in the early years as the business integrates and scales. Over 2 to 5 years, ROC generally improve, recover. When company doing smart M&A, their ROC would be expand. But when companies doing poor M&A, it impact their ROC. So that's all. That's all from my side. I'll hand it over to my colleague Nit.
Yeah, I'm Mit Patel, and I'm going to explain you about capital allocation. Capital allocation is like consuming medicine. One wrong dose or misallocation can transform potential growth or healing into significant loss. Efficient capital allocation means investing in core business or focusing on core business, restraining from no unnecessary diversification and restraining unnecessary diversification and returning excess cash or surplus back to the shareholders when there is no growth perspective left for the company to for the investors. Okay, efficient capital allocation is a critical factor to judge management abilities or quality of management as because the great companies are not just defined by how they are generating cash flows or how smooth their cash flows are, but how wisely they deploy this cash flow to generate higher returns. In the slide, we can see some of the strategies used, such as reinvestment and expansion in core business, discipline leverage by capping debt to equity at 50%, then using external capital buffers to write off non-performing assets, then dividend payout policies, and divesting from low margin brands. So efficient capital allocation is uh, important. It decides the future of the company, whether it is going to survive or going to make more profits in the future, and also the long-term returns of for the shareholders. Next topic. And now working capital. Working capital is the money needed to conduct day-to-day operations to run the business. It's like the blood of any business. If its circulations get slowed down, it leads to rise in working capital requirement, which is often funded through debt or equity dilution. So efficient management of working capital is important to reduce cost of capital, minimizing the use of debt or any other external source of capital which comes at cost, and also the mitigating the risk of liquidity. From investor perspective, uh, disciplined management of working capital is important to ensure stable ROCE, as there is no need to raise capital, which makes capital employed consistent and hence stable ROCE. And with decreasing working capital or with quality cash flows, large portion of profits gets converted into actual cash, which raises the probability of getting dividend payouts. In the slide also, we can see some of the strategies used by these companies, such as reducing credit days, incentivizing cash by giving discounts on timely payment, and also an immediate cash payment, receivables in advance, and deferred payables, as seen in Page Industries, leveraging technology and IT systems at HDFC and Axis to fasten the cash inflows, exercising pricing power to cut dealers' discount, and enhancing liquidity by using bill discounting, and so on. So efficient working capital management strengthens the profitability and liquidity, and it ensures sustainable growth, which eventually protects the shareholders' interests. Thank you. Now I would like to call Varun to explain the further topic.
Hi, I'm Varun and I'll be talking about the market penetration throughout these seven companies. Starting with the paints industry, Asian Paints, their strategy was distribution first domination. Asian Paints, they built India's deepest dealer network, even in small villages. They made their dealers financially dependent through very fast delivery, credit support, and inventory management. They used latest technologies and logistics to ensure that the paint was available to their customers within hours. Second, Berger Paints. Berger Paints' strategy was challenger brand positioning, as they were directly in challenge with Asian Paints. They focused on urban markets first and premium emulsions. So they had strong branding as the strategy, and they also endorsed various celebrities in their advertisements. They had faster product launches to challenge Asian Paints. Third, Marico. Marico's strategy is category ownership. Marico didn't compete across FMCG broadly, but they dominated very specific niches or areas. So they dominated basically in parachute and by coconut oil and Safola, which is health oil and foods. Another strategy they used was aggressive rural penetration, and the prices for all their products was also very affordable. Next, Page Industries. The strategy for Page Industries was premium branding and exclusivity. Page Industries had an exclusive license of selling jockey in India. They focused on premium product quality and brand aspirational value, and they controlled their distribution via exclusive brand outlets and very limited on discounts. Moving on to the banks, Axis Bank. Axis Bank's strategy was targeted expansion. They focused on corporate and SME banking and also selective retail growth. They built their presence in very, very profitable urban centers like Mumbai. They used cross-selling, for example, loans, cards, and deposits. Thus, they resulted in having a very strong penetration in specific customer segments. Next, HDFC Bank. HDFC Bank's strategy was relentless consistency. Yeah, they expanded branches before their demand had even arrived. Their conservative lending helped in building trust. They had adopted digital banking systems very early into the business, and their deep focus on cross-selling to existing customers. Lastly, talking about Astral Polytechnic. Astral Polytechnic's strategy was product-led penetration. So Astral was the first company to introduce CPVC pipes before any of their competitors had in the industry. They also hired very educated plumbers and their contractors directly. They created loyalty programs through strong plumbers, and they focused on premium pricing and not just on volume dumping. Thus, their leadership was in a very high margin in the CPVC segment. Now, uh, the key lesson that we learn throughout these seven companies is very simple, and it's that wealth is not just attained by chasing trends, but it's done also by owning a category, by owning your own category in that segment and letting time do the rest. So, looking at all these seven companies, they didn't just chase the next big idea, they focused on becoming the strongest player in very ordinary businesses in their own segments. So, by owning distribution, building trust, and reaching almost every customer in their market category, they gained pricing power and stability. And over time, through consistency compounding, these unusual billionaires were created. Thank you.